Welcome to the Treasury Update podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome to the Treasury Update podcast. This is Craig Jeffery, your host today. I'm the managing partner of Strategic Treasurer. Today's episode is entitled Tactical Adjustments in the Cash Conversion Cycle, Driving Cost Savings and Improving Liquidity. Our guest for today is Vikas Shah from LSQ. Vikas, so good to have you on the podcast. Being strategic matters, but the tactical aspects of our business have come into focus at the latter part of 2023. The tightening of credit, rising prices, they're all amplifying the focus on cost savings for many companies. The cash conversion cycle is an area of emphasis for driving out costs without losing the ongoing focus on liquidity management. Vikas, as you heard in the intro to today's episode, you and I both love to talk about working capital management. In today's climate, the economic climate, the situation companies are in, I suspect you're seeing some of the same type of response to the market challenges. There's a drive to cost savings that now probably equals a focus on working capital management, whereas it used to be almost or very heavily focused on working capital management in the past. What are you seeing?
Craig, first of all, thank you. Thank you to have me, and super excited to be here as part of the podcast. To answer to your question, Craig, it actually used to be the opposite. There used to be a huge focus on cost savings, and working capital wasn't a top priority for the office of the CFO because cash was almost free almost 18 months ago. And since the Fed has started to increase interest rates, combined with tightening credit, combined with higher inflation cost, working capital has become top of mind for the office of the CFO. Now, having said that, cost savings continues to be also of equal priority for the office of the CFO. So what's interesting is that a lot of these corporates are now trying to figure out the right balance between working capital improvement and cost saving levers. And it's fascinating to see what's happening in the market right now with, tightening credit. Everybody's trying to hold on to cash as much as possible. All the CFOs are looking for alternative options to make sure that they have ample liquidity available across their lending syndicate. And finally, cost savings continues to be an important lever as well, because a lot of the companies are trying to contain margin and continue to drive that cost savings in today's market environment, which seems to be quite unpredictable and volatile.
Excellent. I know we'll get into some of the cost savings and the efficiency drivers, but maybe for those that are listening to the podcast, it would be great if you could just give us a rundown on what's your role at LSQ and what type of problems does LSQ work on solving, just by way of background?
My role at LSQ is all things go-to-market. I'm responsible for driving sales, business development, marketing, and customer success across our entire customer portfolio. LSQ is a leading industry working capital and payments platform company. We help small to mid-sized businesses, mid-market and large enterprise customers automate and digitize their AP and AR functions while simultaneously improving cash flow and access to capital for these businesses. On the accounts payable side, the typical pain points we often see and we try to solve for are customers dealing with tighter terms with suppliers. Supplier risk is a big topic. Manual and paper check payments is another one. Unpredictable supplier cash flow needs and a barrage of supplier inquiries. These are the typical pain points we see on the AP side. On the accounts receivable side, the pain points we tend to see are mainly related to longer collection cycles across their entire customer base. We also see lack of credit management tools to support customer growth or a diversified customer base, delayed cash posting timelines. It takes a couple of days for all of these customers to post cash, and thereby it impacts their days sales outstanding metric. There is no visibility into the quality of the customers, the credit quality of the customers that they're working with. And then most importantly, there's lack of access to capital to manage their receivables.
Well, those sound like a well-balanced set of challenges, both capital-oriented and efficiency. If we look at some of those examples of cost savings that you alluded to or discussed some of the broad categories, where are you finding your clients are most likely to find cost savings? Is Is this finding it through direct reduction of defects, adding scalability, allowing for some type of cost avoidance? Instead of hiring someone else, you can handle it by automation. Where are some of these areas for finding the savings?
Yeah, that's a great question, Craig. Depending on the size of the company, whether the company is a small to medium-sized business or a mid-market or a large enterprise company, also depending on what industry vertical or sector the company is operating under. And then finally, it also depends on the credit quality of the business, which is something that, historically a lot of vendors didn't really talk about that. But in today's environment, that's an important vector to really figure out what kind of cost savings the company can potentially drive, because it's hugely dependent on the credit quality of the customer as well. Some of the examples we're seeing for cost savings, which are not limited to this list, but in no order of priority, are related to, first and foremost, how can a company save interest expense with either reduced or cheaper cost of borrowing? As I mentioned earlier, the cost of borrowing has gone up significantly. For an extremely good quality credit company or investment grade credit, the cost of borrowing is mid-single digits. And if your company is not in that spectrum of credit, then you're talking about at least single high digits cost of borrowing. So I think that becomes a very expensive line item for most CFOs and treasurers. So that's an area of focus for a lot of CFOs right now. Another area of cost savings opportunity is just automation efficiency. We've seen lots and lots of vendors trying to focus on the office of the CFO, but there are also lots of options, and it's really hard for the CFO to kind of figure out where to prioritize, which projects to work on, and where can I unlock automation efficiency to drive that cost down. Digitizing payments is another area. Unfortunately, at least in the US, depending on the size and the industry segment, there's just a lot of payments happening manually, either over check or the process itself is very manual, where there are people involved behind the scenes to send vendor payments either multiple times a week or send vendor payments to different business units and such. So that drives a lot of cost for the office of the CFO, and that's another opportunity. Supplier and customer information management, there aren't really good systems in place to help these teams manage all of that information. So what ends up happening is that the teams end up spending a lot of manual work in Excel or in other sources to really figure out how to communicate and collaborate with their customers and suppliers. So this tends to be another area of cost savings opportunity. And then finally, this is a hidden item that some companies incur and most vendors are not aware of, which is credit insurance cost. So again, depending on the credit insurance of your counterparty that you're working with, you're probably carrying some insurance cost. So you want to be in a position to really understand the credit quality of your counterparty to try and either avoid that cost or offset that cost. So this is again emerging as another area of cost savings opportunity when it comes to the broader topic of cost savings and working capital management for a business.
So Vikas, if you had listed these, I think you described it as in the order of priority. Do you see any of these becoming more important, let's say over the next 6 months, maybe moving up, or any you expect to move down?
That's another fantastic question. I would say the focus on cash conversion cycle and any costs related to that is going to be top priority for most CFOs. And I think an immediate second would be most likely automation efficiency and cost savings thereby. And that could be in the accounts receivable side or accounts payable side or broadly across the office of the CFO. But automation is going to be another hot topic, right after cash conversion cycle.
It always seems to me that one of the biggest areas for inefficiency is a bad process or a manual process, something that's not automated, something that's designed poorly, and that leads to defects. Someone calling, some type of compensating controls in a process to make sure errors aren't there. If we break things up in that category, it seems like several of these items that you list are some of the major subcategories of that. But any thoughts on the idea, the entire process and automation working together, how companies should think about that?
Most CFOs and treasurers we talk to, it's a fairly daunting task for them. They struggle to kind of figure out where to start, how to prioritize, Is this going to be a huge lift and change management initiative within their organization? So they're very reluctant to embark on a holistic project because it can disrupt their day-to-day operations. The CFO office is also a support function for the entire business, so they don't want to make sure that the business continues to grow and continues to operate in a meaningful way. So it's really hard for the stakeholders within that office to kind of figure out what's the right priority. And it's really important for them to understand, first of all, what are the possibilities, and even within all these options, there might be some low-hanging opportunity for them to prioritize, just given lack of bandwidth or lack of expertise within the organization, and partner up with leading industry experts to potentially pick one or two projects to start showing some quick wins. So there are different ways to do this. Certainly, we don't recommend a big bang approach, but within the AR department or the AP department, I think you can carve out specific areas, or even carve out specific cohorts of either spend or collections that you can focus on. Might be a certain region or a business unit, or it could be a certain spend category or a certain type of customer category, and try to pilot a new process or an automation project within that small cohort and see if you can see some improvements. And if you do through those pilots, then you can keep expanding beyond that. So I think in summary, I would say is that you don't have to take a very holistic big bang approach. You can start small with some pilots, start seeing some quick wins, earn that credibility within the organization, drive some immediate cost savings, even though that could be small. But I think about it as a journey over time on a monthly, quarterly basis, as opposed to embarking on a bigger project up front.
Yeah, sounds good. Maybe little bangs as opposed to big bang. The overview that you just gave on the different areas is really quite good. And every time I've talked to you, you've always had examples or case studies and you tell them in a way of stories. I'd love to dig a little bit deeper if you have some of those case studies about how companies are driving cost savings in their organizations, driving costs out of their organizations. Love to hear some of those examples, especially as they're instructive to other companies. Others can learn from that.
Yeah, I'd be happy to. It's all about those stories and nuggets. We have many of them here at LSQ. My first story would be on the accounts receivable side. It's a story around faster collections and credit management. We have a customer called Clone Lab, and they used LSQ's collection and credit capabilities to keep them away from actually hiring folks within the credit department and the accounts receivable department. And this has really helped Clone Lab to essentially free up their AR staff to work on more strategic priorities. Another story, which is more on the accounts payable side of our business, is helping a company called Rochester Iron, actually one of the largest suppliers on our platform, to automate early payments. And the way Rochester Iron dealt with this was essentially completely automating and setting their own terms, on the platform. So this eliminated a whole lot of manual effort, reconciliation effort, around making sure that the payments actually happen in a very streamlined manner. And no one really had to spend cycles requesting payments or tracking aging reports and such. So this drove a lot of cost savings for this company as well.
Without getting too much into the details, how did that work?
Well, the company would essentially use our Fast Track platform. They would essentially go in there and really figure out for a month or for a quarter, what terms would they like to have. They would be able to calculate the cash flow needs, and the platform would suggest how to set their own terms, and they would be able to set their own terms and just set it and forget it. So they don't even have to monitor each and every invoice that's coming due. They do not have to monitor their aging reports. All of that is done automatically through the system, and they're able to solve for the cash flow they need for a given month or for a given quarter.
Do you have any other stories?
Yeah, we got a few more. A large specialty chemicals company we're working with. We help them improve working capital on both the AR and the AP side, and that led to a massive, interest expense savings for the year. So they've been able to rely on that and essentially put that as part of their financial reporting for year end. So it's been a huge win for this company. Another company we've been working with recently, that's a large industrial manufacturer. They have discount payment terms from their suppliers. So the suppliers have actually offered them these discount payment terms, but this company as a buyer has not been able to leverage these discount payment terms because they don't want to deploy their cash to offer the discounts to the suppliers. So in this situation, we were able to step in and actually help this buyer seize these discount payment terms and really help them with the supplier relationship side, providing these discounts to these suppliers, and then potentially passing a portion of these discounts back to the buyer. So in the traditional model, the buyer was actually capturing some rebates. They weren't able to do that because they didn't want to use their balance sheet. Now, with help of LSQ, we've been able to help them not only maintain those supplier relationships, give those discounts to the suppliers, but also potentially capture a portion of the rebates back. So this led to a really healthy cost savings margin improvement metric, for the CFO.
So that's a pretty interesting example on the capturing discounts. If someone's extending discounts to get paid early, there's always that risk that not enough of their customers are going to pay them early. And so just providing the capital, it certainly meets the financial needs there. But is there any feedback as to how that supports and helps the relationship between, let's say, your customer and then the company that needs to get paid?
It's a huge benefit for both the buyer and the supplier in that dynamic, because traditionally the supplier did offer a discount payment term. These are terms like 210 net 30. Essentially, the supplier is offering the buyer a 2% discount on the face value of the invoice if the buyer agrees to pay that supplier within 10 days on a net 30 invoice. And there are a lot of these discount payment terms that exist in the industry today. But what's happened is, because the cost of capital has gone up dramatically, the CFO is not able to provide these discount terms to the suppliers because they don't want to use their own cash. Any partnership that steps into that equation and provides this continued opportunity for the suppliers to take these discounts and help them with cash flow is a huge win-win, both for the buyer and supplier.
These are great examples, Vikas. We have time for one more if you have another example.
Yeah, sure, correct. The last example I have is our partnership with Infor, who is a leader in supplier vendor management solutions, and our customer, United Legway, who is a global manufacturer for retail athletic apparel for Puma. And the partnership really expands on this opportunity to enable United Legway to provide an early payment program to all of their foreign suppliers. And this capability really helped United Legway significantly reduce AP operation cost and also reduce their working capital needs to support the increased demand for supplier early payments from all of these foreign suppliers. Now, a lot of these suppliers were actually based in Asia, facing high cost of capital. So this was a huge win for United Legway in terms of maintaining the supplier relationships. But most importantly, it drove a lot of AP operational cost benefit for United Legway, because they were able to expand from the incumbent domestic program that they had with LSQ into the global supplier base on one unified platform.
Thanks for all these case studies or stories that you had. We're going to move on to some final thoughts. So, as we talked about some of the general situation, you gave some case studies and we talked about the challenges they have. What guidance or final thoughts would you offer companies as they navigate tighter markets, maybe less access to capital, more demands from their trading partners, and those that face some of these cost-saving pressures?
Yeah, I'd love to summarize the final thoughts maybe in 3 bullets here. The first one being, evaluate your AR and AP operations, tech stack, and all the metrics around it. You'd be surprised that there are lots of low-hanging opportunities to save cost and man hours. The second one would be, cash is no longer free. With SOFR trending at 5% plus, the baseline borrowing cost is now single high digits if you have decent credit. Every dollar of cash conversion cycle on your balance sheet can save you valuable interest expense. So consider optimizing AR and AP based working capital sooner rather than later. And also think about it as a journey over time, not as a one-time shot in the arm, because it does take some time and effort to focus on it. But getting started earlier is going to give you a huge leg up in the market, especially vis-a-vis competition when it comes to overall working capital improvement. And the final thought would be, Be proactive to explore your credit and lending options, especially with non-bank partners, to diversify your capital stack. So don't be overly obsessed around just cost of borrowing, because you may be able to get less restrictive terms with another partner for marginally higher cost, but you will save lots of money and provide much needed flexibility and control for your business in the long run.
Excellent. A lot of good points. I think there's certainly more we could talk about there and on this topic. I really appreciate your time, Vikas. Thank you so much for joining the Treasury Update podcast.
This was exciting. Thank you for having me, Craig.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.